Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney and founder of IRA Financial. On today's episode, 3 superb questions, one involving Roth conversions and a 401k, another involving doing a real estate deal, and 5500 EZ filing requirements for your solo K. Will equity and debt, you combine them to get to the $250,000 value requirement? And then thirdly, real estate deals, commingling HSAs, Coverdale's, Roths. Can you do it? Can you commingle retirement accounts to do a deal? So really excited about today's episode. And without further ado, let's get started. First question's from YouTube. And this person wants to know, can I do a Roth conversion in my solo 401k plan if I'm under the age of 59 and a half? So it's a superb question. And it's a quite simple answer. Yes, there are no age restrictions for doing conversions. As long as your plan allows for in-plan conversions, which most plans do, and IRA Financial solo 401k plan does, so you don't have any issues if you're a client of IRA Financial. There are no age restrictions. When you do a Roth 401k conversion, you pay tax on the fair market value of the asset you're converting. Not what you paid for it, but what it's worth on the day of the conversion. Cash is cash, and obviously if it's in liquid asset, you want to make sure you have an accurate independent valuation. Now, you don't need to hire Ernst & Young to do it, but you should get a real estate professional or someone that's independent that has the capacity to make a professional opinion on what that value is. But you should not just make it up and do it yourself. Now, if it's publicly traded stocks or cryptos or gold where there's a spot market, that's not an issue. But and even real estate now, honestly, is really not a problem because there's so many online sources. There's tax records. You can get a realtor to provide you a letter. But if it's a private business interest, something like that, you're probably going to want a third party to attest to the value. If you're a client of IRA Financials, we will handle the reporting, the 1099-R, which will show the conversion, show the value, and then the amount of the conversion will go on your tax return when you file it April 15th of the following year. And whatever other income you have, the converted amount will be added onto that, since conversions are taxable as ordinary income and not capital gains. And then your tax rate will be based on the aggregation of all your income for that year, including the amount converted. So thank you very much for that wonderful question. Second question is from Jeremy B. of Torrance, California. Jeremy wants to know, I have a solo 401k plan that owns real estate. I paid $185K cash for the property and have a $75,000 loan. Do I have to file a 5500 EZ? So really, really good question. I haven't tackled this one in a while. I actually went through, not an audit, but kind of a letter writing campaign with the IRS probably about 7 or 8 years ago for a client that had this exact issue. She owned real estate. She had, I think she put like $100 and something thousand down, but she took a loan, and when you added the loan to the cash she put in and the value of that asset was over the 250. But in her estimation, she took the position that, hey, yeah, when you add the cash and the note, the value of that property is above the 250. But my cash in is only whatever, 150. So it's under the 250. So since my equity position is under 250, I don't have to file the 5500 EZ. And the IRS, they basically just sent her a letter saying, hey, you haven't filed it this year. You did last year. What's the deal? And she responded saying, I don't think I have to because the value of the property is above 250, but my equity position's under. And they actually wrote back and said, no, you should. Here's the rules. And they didn't penalize her. They just allowed her to refile it, which is very nice. So it's just a story I always share. So it's like if someone asks you how much your house is, you don't say, well, I put 50K down and I have a $300,000 mortgage. No, you say, oh, my house is worth 350. That's what the IRA said. They're like, we care about the value. We don't care how much you put in. So if you put 185 cash down, you have a note of 75. That's great. But if the property is valued at more than 250, you got to file the 5500 EZ. Even if you only put in 185K in cash, it's worth the value of the properties, including debt, including leverage. Okay, so just remember that if you have real estate with leverage in your solo 401k, you got to include the leverage amount and the value. And obviously, you just first thing you should do is look at the value. Right, you go online, say, oh, the property is worth 300. Okay, I have to file. Even if you only put 100K cash in, and you have a note for 150, it's all about the value, not your equity infused. So thank you, Jeremy, for that really good question. Third and final question of today's podcast is from Sammy T of Amarillo, Texas. Sammy wants to know, can I combine my HSA, Coverdell, and Roth IRA to buy real estate with IRA Financial? And another great question, and a really simple answer is yeah. Yeah, IRAs, retirement accounts are not disqualified people. If you look under 4975E2, it's the IRA owner. You're not going to see the word retirement plan as a disqualified person. Okay, so technically, as long as you fund that LLC with all your accounts, the HSA, the Coverdell, the Roth IRA, they're all subject to 4975. Even though Coverdell and HSA is not an IRA, it's still subject to the prohibited transaction rules under 4975. However, a retirement account is not a disqualified person. So yes, you can combine retirement accounts. I would suggest setting up an LLC, having the Coverdell, HSA, and Roth all come in as partners. Ownership will be based on the amount of cash invested. You can serve as the manager of the LLC. The LLC will give you the limited liability protection as well as the checkbook control. And then based off the operations of the LLC, all the profits and losses will flow back to the accounts pro rata based off their ownership. So you can do it, Sammy. I would suggest funding it simultaneously. The IRS, the Build Back Better bill of September 2021, they wanted to stick a provision in there that said retirement accounts are disqualified people. Not sure I would even stop this because technically you can fund it simultaneously, but I don't think they wanted people transacting or people are lending money between their Roth and their traditional or their IRA and their 401k. I think they just kind of want to stop that. But the Build Back Better bill never passed. It never made it into any subsequent legislation. So as of today, May 2023, a retirement account is not a disqualified person. So you have a little bit more flexibility structuring investments. Otherwise, that's it. Hope you guys enjoyed today's podcast. Did I say May? It's actually June. Beginning of June 2023. So calendars turn from May to June. So sorry. But still, as of June 2023, there's no legislation stating that retirement accounts are disqualified people. That's it. That's a wrap. Hope you guys enjoyed another ADMAIL. I keep them short, but I personally love these podcasts. If you're watching on YouTube, much appreciated. They're fun. They're really great questions from folks, and I think we can all learn from them. So hopefully you guys enjoy them too. And that's the name of the game. Get to learn from each other, share information, collaborate, and all become better self-directed retirement investors. That is the name of the game. Take care. Have an amazing rest of your day, and talk to everyone again next week. Take care.